behalf of Biz Talk Today TV and CrossCheck Media, welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out in sunny and scorching hot Scottsdale, Arizona. Toby?
Air conditioning, baby.
No comeback on that one?
No, it's freaking scorching hot.
Okay.
I mean, yeah.
There we go. We got the weather report. That's wonderful. Yeah. But all eyes today, we're on the Federal Reserve, and that is one scorching hot place because everybody wanted to know what Jerome Powell and company were going to do and if they were going to signal interest rate cuts anytime in the near future. We're our guest today. He's here to answer all of those questions and then some. Welcome, everyone. Then we have Sam Stovall. He is the Chief Investment Strategist from CFRA Research. Sam, welcome back to Buy, Hold, Sell.
Hey, happy to talk to the TNT boys again. You guys are dynamite.
You know what? If you take amphetamines, Sam, you can be as up as Todd does. It's a chemical thing.
There you go. Absolutely. I got the Panera lemonade going on right now. So,
oh, do you? All right.
But Sam, I gotta go with you on this one. Here you had Jerome Powell. He came out very optimistic. The tone is very bullish right now. He is and dovish, so he's talking about interest rate cuts possibly as early as September. Do you think he's maybe fibbing, or do you think that's where we're headed?
I think that's where we're headed, Todd. I mean, when I heard him say that as for reaching our inflation goal, inflation data have added to our confidence, I think that basically was the signal that, yes, we will most likely cut in September. What's more, we're probably thinking about starting a process, and that this process would also incorporate cuts in November, December, and then heading into 2025 for more cuts.
Yeah, here's the thing about, he's very coy usually. This is the least coy I've heard him in a while. You have to actually be a cunning linguist to figure out, what verb and adjective, means yes or no. But the expectations are so high. When you get like 97% of the Fed fund futures showing the cut in September, he knows if that was his intent, he has succeeded. They're going to cut. If it wasn't his intent, then he's in trouble, because the disappointment would be that 5-8% haircut in a nanosecond. We used to say, remember, Sam, the Fed's in a box. Well, he put himself in the box. The box is there, and he ain't getting out. And that it makes sense for all the obvious reasons. I'm just glad to see. There's still a few recession is coming bears. I get scared when I don't hear any recession is coming. I think they read the Chinese or something. They look at the data and it looks like backwards. We need some bears, Samuel. We need some bears.
Yeah. Well, speaking of bears, because Sam, you actually have been quite bullish, actually. You've been coming to Buy, Hold, Sell. I mean, you've been on the show many times and with a very bullish stance. You were recently in the press about a month ago with a somewhat bearish prognostication saying that the S&P might actually drop 5% before the end of the year.
No, 5%.
I know, it's a pearl clutcher, absolutely.
Yeah.
But Sam, I got to ask though, with all the momentum that we have in the markets, and since you made that call, the S&P is up, well, almost 1%. I mean, do you think that we might still be in trouble in the fourth quarter, or do you see this thing riding through all the way into 2025?
I think there's always the possibility of a decline of 5% or more. The real question is, how deep does it go? Does it go into double digits, and for how long? So when I make those kind of projections, yes, it's based on history, and I still believe that we are due for a second decline of 5% or more in this calendar year. But I also like to channel my father, who used to say that it's never really wise to be bearish. It's okay to be cautious, because Americans are optimistic by nature. And if you are a bear and you're wrong, you're ridiculed. If you're a bear and you're right, you're hated. So what I do is basically try to warn investors that volatility is natural. So don't allow your emotions to become your portfolio's worst enemy. And I go even further by reminding them that On average, it has taken only a month and a half to recover from an S&P 500 decline of between 5 and 10%, and only 4 months on average to get back to break even after declining as much as 19.9%, or meaning staying just a shade below that bear threshold.
So
Yeah.
hold on, Toby. I know Toby wants to jump in here, but I have to ask, what's the justification for the 5% drop?
Well, we got to 4.7% just the other
Right.
day.
Yeah.
One reason.
What do you want, Todd? Jeez.
Well, I mean, is there something? I mean, are we talking about earnings are in trouble? Are we talking about some other event? I mean, it's
All
an
right, well,
election year. You would
I
think
think what was, well, we've had many election years in which we've had bear markets. Remember 2008?
Mhm.
Even though that's not where we are right now.
Yeah.
Basically, when we started this earnings reporting period, the S&P 500 was trading at a 38% premium to its 20-year average forward PE. The S&P 500 tech sector was 0.5% away from its exposure to be equivalent to where it was back in August of 2000. Its premium was 78% to its 20-year PE and higher than any other PE since 2000. And when you look to the relative performance of the cap-weighted tech versus the equal-weighted tech sectors, again, you were looking at numbers that were not seen since the dot-com bubble.
Yeah. Todd, may I speak now?
Please.
I try to tell investors, and I have money management clients, and I have thousands of newsletter subscribers, right? And when people run their own money, it's so difficult to try to teach, but I try to teach the idea that in the stock market of the modern century, Sam was in the old one, now the new one, so he's got some good context. In this context where of the trading every day, 70% is algorithmic. Of the trading of those algorithms, most of it's momentum. That meaning that they're going to buy the stocks that have strong upward momentum until they don't, right? There's constituencies in the ownership of stocks. At the bottom are the long-term pension plans who don't trade, and they are mostly long only, and they hedge with other type things. And they don't give a heck about what a 5% drop one day. What happens is when you get this concentration that we've had because of the AI bubble, you start running out of real investors. There's people who are saying, yeah, I see value of NVIDIA, 2 times what it is today, so I feel like I'm getting a bargain here. Those are what we used to call them fundamental investors. I just call them like real investors. We run out as we go farther up this climb. We start to run out of real investors because everybody owns the damn stock. There's not, if you look at the mutual fund listings of what they own, every mutual fund in America that's a growth one owns NVIDIA. So unless there's new money coming in, remember, in the first 15 days of July is always sort of a downtime. I mean, an uptime, because they're getting funds in from, after the first 6 months. Now this is new money going into index funds. But at some point in time, Todd,
okay,
everyone who is going to buy has bought. Yeah, everyone who's bought is bought. And one news hits, all these guys now have sell stops underneath their positions because they're not owners, they're just renters. Yeah. When you get a lot of renters at top of the heap, then you're going to get these 5 to 15% pullback. Look at NVIDIA. It had a 20% pullback. Is that a bear market? No, it's up 387% in 12 months. That's 30 years of gains in 12 months. So it's healthy to have these pullbacks. And what you do is all you're doing is you're shaking out all the momentum players. They don't even know what NVIDIA does. It's a computer. It's just the momentum says buy. As soon as it drops below the 50-day moving average, then other people who actually buy based on value start to replace them people, and then we do the whole thing again. That's the game that Wall Street is today.
That's right. That's right. But Sam, let's stick with that theme on the technology sector. So I know that you are bullish in this sector. You've been quite vocal about the growth prospects for actually the larger cap tech companies. But what do you think, though? I mean, in history, have you seen this type of a run by one sector, and how long does it normally last that could keep propping up the markets?
You talking to Sam or talking to me?
I'm talking to Sam because Sam is
Okay.
the expert today.
Okay,
Although
thank you.
you're the expert too, Toby. So don't. So
You're the expert every day, Toby. I'm just the expert for today. Yeah, I mean, there typically you have had experiences when you've had sectors that have been the real outliers, leaders. Energy back in the late 1970s, representing 28% of the S&P 500. Financials leading up to the financial crisis, et cetera. So it's usually the leaders that people get focused on, and they don't want to miss out. So they get sucked into the FOMO trade. And now it's technology similar to what occurred back in 2000. But the question is, okay, are we at 2000 kind of valuations, at 2000 kind of levels, or do we just need to take some of these profits, rotate them into other areas of the market, and thereby, in a sense, correct in time with technology, but allow the other sectors to benefit? And that's essentially what we have seen in the month of July, where we've had basically all of these sizes in positive territory, large, mid, small, with small caps up 11%, mid caps up more than 6% versus the 1+% for the S&P 500. All the sectors but the high flyers of tech and communication services were in positive territory, and 80% of the 155 sub-industries were positive. So we've seen some rotation, not just into the mid and small, because I would have been very worried if that was all you saw, because I like to say that thinking that mid and small cap stocks could absorb an exodus from large caps would be like believing that you could drain a Great Lake into your backyard swimming pool. You just don't have enough volume.
Yeah.
Market cap. Mid and small cap together represent only 8% of the S&P 1500's market cap. Large cap is 92%. So I think I'm encouraged by the fact that you've had the 493 large cap stocks start to do well, along with the mid and small cap indices.
Yeah, and Todd, the other concept that I think self-directed investors sort of have a hard time with is risk management. And when I ran a mutual fund, I would get dinged. I'd get an email or an angry phone call. Remember, you're overweight this and so on and so forth. Because I really, ran it the way I ran my private funds, and you can't do that. So
when you said remember, I thought you were quoting Charlie Brown's parents, but
I was. But the risk management comes in. If you look at the corpus of all the money that's managed, okay, you have indexes, and Sam will know exactly what percentage the major index are of the overall market. But for the actively managed money, the actively managed person, by definition, by charter of their agreement with the investor, usually, pension and endowments and so on and so forth, is that they will practice risk management, which means if any of their sectors get overweight other than their allocation, they by definition will trim that. Now, sometimes the guy or woman can be gone for 3 days, and in the NVIDIA case, and all of a sudden they're overweight in 3 days. And they have some flexibility. But in risk management for the big money, this is why this is why we have taken profits 3 times in NVIDIA, 4 times at SMCI, 4 times in Arista Network, et cetera,
Yeah.
because they're at some point, other things, the managers, the professionals are gonna have to go into other things because they can't go any more into tech. They're allocated out, they're maxed out. So that's why, and that's a healthy thing, Todd. That's a healthy thing for the market.
Okay.
And I would only argue that obviously the difference in 1999, when my MicroStrategy stock had gone up 1,100% in 9 months, was that they never made a dime of profits ever. I mean, if you look at SMCI, up 800+ % before they pulled back, also another 20% pullback, very healthy. They're selling at a 4 to 37 PE. So I don't think there's any correlation between the dot-com melt-up and the AI melt up, other than there's irrational exuberance around what people think AI is going to deliver them like tomorrow. And then I say, well, then go sign up for Copilot for a week and go see, how if Copilot is helping you work better, faster, choosing, because right now it does not.
Well, that was a reference to Alan Greenspan, the irrational exuberance. We haven't used that term, I think, this entire series. So this is great. So listen, guys, let's leave it on this block, because coming up next, we have to ask Sam all about sectors. We talked about technology. He brought up a couple of historical sectors that have done well. Let's talk about now. What can we expect for the rest of 2024 and going into 2025? So with us today, we do have Sam Stovall. He is the Chief Investment Strategist at CFRA Research, and we'll be right back right after.
Make us money, Sammy. Make us money.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Welcome back to Buy, Hold, Sell. Well, a big run-up in the stock market. We saw the S&P 500 have its best day since February after Jerome Powell and the rest of the Fed came out and they did not cut, but they did signal that they're likely going to be cutting rates come this September. Our guest likely. Our guest today is Sam Stovall. He is the Chief Investment Strategist at CFRA Research. You can go to CFRAresearch.com to learn more. Sam, when we left off in the last block, we were talking sectors. Now, everybody knows you like tech, but everybody likes tech right now. Give us a sector that you like right now that you think is going to outperform maybe for the rest of this year and beyond.
Well, we have overweight recommendations on tech, on communication services, and on financials. Financials is a group that, somebody might say, well, that's really nothing new. We've seen an improvement in that group, particularly in regional banks, et cetera. But we do think that that is something that is likely to continue. The market itself traditionally does well in anticipation of the first rate cut. I tend to think, however, that anticipation is greater than having, because when you look at the returns, the average price gain is about 16% between the last rate hike and the first rate cut, going back to when Alan Greenspan started to announce Fed funds changes back in 1989. But then when you look about 12 months out after the Fed has started to cut interest rates, the market is up only about 5% on average, primarily because in those prior periods, you ended up being concerned about recession. We don't think recession is on the horizon. One reason is if you take a look at the sectors that are doing well, we know that the market is a discounting mechanism about the future. You don't try to figure out the economy to then say which sectors are going to do well. You look at sector outperformers to then say, where does that imply the economy will be 12 plus months from now?
Mm-hmm. Yeah, Todd, I'm telling you that I'm looking at the screen, $1 million portfolio, up 9.5% in the last, today, basically.
Make it rain, baby.
Yeah. All right. So we know what's really up. Obviously, the technology stuff we have, but my oil tankers, which pay 14 to 28% dividends, they're up, 3.5%, 4%. I say the second derivative AI plays, which is a fancy way of saying companies that don't create the AI tech stack, but they use that AI tech to deliver real value to their customers. So there's a company called Verint, VRNT is the ticker symbol. The stock's up about 60% for us. It's up 11% or 9% today. Why? Because they go to insurance companies, huge insurance companies all over the world, and they take their data, they process it, and then in a chatbot way answer questions that you used to have a financial analyst ask. Like, we have 422 different bonds in our bond portfolio. Which are the ones that are most coming due? What's the yield? And then what would be attractive? and it will tell you in a 5-second splash, or we're underwriting, this new thing, and what about Verint is the perfect second derivative customer here of AI, because they're taking it and then delivering value, and they're increasing their revenue 25, 30%. My point is, the easy stuff is buy the AI stack that everybody knows, the tech stack, right? And you go all the way down, and we did all that now a year and a half ago. So hooray for us. In the next 12 months, there is no freaking way that those stocks are going to go up on average 193%. No way, no how. They're going to consolidate for a while. I don't know, 3 months, 6 months, I don't know. But I want to make money over the next 6 months. And so we're moving, cash into other sectors that have the growth, the value that they're AI adjacent. And I'm an inflection investor. So we're looking for a demand, a pricing up curve, a switch up curve, demand, secular change. And there's a lot of secular changes out there, Todd, that have nothing to do with AI. And people, if they're getting into AI today, OMG.
Yeah. Well, Toby, you did bring up something interesting there, and that's the energy sector. I got to ask, Sam, what's CFRA's stance on energy these days?
Well, we like energy. I mean, we do have a specific market weight on the category, but our belief is we're likely to see higher oil prices as we move into 2025, and we are ending up with continued buy recommendations on some of the major categories, but also when you're dealing with higher prices, you want to be focusing more on the upstreams, as well as some of the transportation companies. The downstreams are the ones that benefit from the lower prices in oil. But in general, also you have many companies like Exxon, Chevron, BP that offered very nice dividend yields. So you can get some growth as well as the income. And what Toby was just talking about is, in a sense, profiting from the peripherals, meaning from the outside portions. I mean, he's sort of reminding me of Levi Strauss, who decided, well, let me sell the overalls to the miners. I won't become a gold miner myself, but I will profit by selling the utensils and materials to those who want to do the prospecting.
Yeah, picks and shovels, baby. Picks and shovels. But Todd, honestly, regional banks, for example. So there's another big inflection that's going to be happening, and we now all know what it is. Interest rates are coming down. So who are the beneficiaries? So we own NAIL, which is a ETF that owns home builders and home building products. Why? Because they're going to benefit. The 50% lower income side of the United States, that only accounts for 3% of the wealth in the world, which in our country, which is very sad. But they spend everything they get. We've been in Dollar General from about $60. It's now like $110. My point is, there's positive inflections, there's negative inflections. Positive inflections, when inflation went here, that created an inflection demand for Dollar General stores. So secular change, the rate of change of the rate of change. When it goes this way, you make money, and it can be at the full market with interest rates coming down. I love regional banks. Huntington Bank, we've owned Huntington Bank. I love regional banks that are profitable. They have 2% of the offices, but the easy stuff is done. Sam knows this. The easy stuff has happened. Now you have to roll your sleeves up here, find micro sectors that have inflection demand growth, that have pricing power. And they're not all going to be tech, but I'm always going to hold my AI tech stack is about 35, 40% of our portfolio.
So Sam, on the oil, you said you can see oil prices rising for the rest of the year, but typically if there's a recessionary environment, you have less demand. Not saying we're going into a recession, but there is a slowdown. So how do you see oil prices rising?
Well, our belief is that China will probably get its act together in the next year and could see an improvement in the demand from China. Also, with many of the countries, the EU cutting interest rates, Bank of England, et cetera, that could also help to spark some economic activity. And also, just looking at the tensions in the Middle East, we think should provide artificial support to the price of oil. So, when you look to a particular sector, you probably want to play it safe. For some people like myself, I wear a belt and suspenders. I would go for those integrated that benefits from the upstream and the downstream. But if you're looking specifically at higher oil prices, you'd want to focus more on the upstream.
Yeah, and also, but Sam was getting to as well, which is that, again, now this is like hand-to-hand combat here. Before, we're just riding a rocket ship, find a rocket ship, sit down, you're up, 50 grand every week. You're the smartest person in the world, yada, yada. Now we got to actually earn it here. And so one thing that counts are stock buybacks. We're in the non-stock buyback period right now. But Exxon and Mobil, oh my Lord, they bought back 6% of their shares. If you have a bid in the market all day for 100,000 share lots, that seems to help your stock price go up very well, and it also reduces your earnings or increases your multiple. So again, I hold a core position. Let's call it 30% in the stuff that hasn't gone crazy, and make sure you took profits from those. Move those profits into other secular growth things and lower your expectations, because those are not going to be up 200% in a year. All right. Let's come back to earth here. And, the stock market's returned 10%, 10.1% a year since Sam was born. And if you're up 30%, you've gotten 3 years of gains in 1 year. If you're up 200%, you've gotten 20 years. Let's not be greedy out there, folks. Let's pocket some of that and do some risk management. I'm sorry, I feel like a preacher today, but
no, I get it. Absolutely.
It's also a reminder that the biggest gains typically come early. In overall move. 2023, you had the three worst performing sectors in 2022 up an average of 50% each in 2023 as we recovered from that bear market. So it's like a ping pong ball dropping on a table. The first bounce is the greatest, and subsequent ones are more.
That's good.
I like that one.
Wow, that is good. That is very good,
like
Sam.
that one.
That was very good. One final question for you. Let's switch gears here. Would you be a bond buyer in this environment?
Well, even though I work for the equity research department,
right.
My feeling
you're an investment strategist.
As an investment strategist, yes, you do need that. You should have some exposure to fixed income, because we probably are going to be seeing a reduction in interest rates as the Fed itself is cutting rates, as the risk of higher inflation tends to be relaxed, et cetera. So yeah, we've seen that already, where the 10-year yield has come from 4.3% down to below 4.1. So that's certainly going to be a benefit for fixed income investors.
And let's let the audience remember that when interest rates come down on a fixed rate instrument, the value of that instrument goes up. So the combination of yield and appreciation. So we're in 3 and 5 year Treasury bonds. We're getting about 5% yield, but as they're up about 4.5% just in equity appreciation. Now that's the bedrock of your portfolio. But to have your portfolio on all the high flyers is a recipe at some point for not only, it's not disaster, it's just that it's a lot of brain damage. When you show your brother like me, you're up $19,000 in your portfolio, and then you show him, well, I'm down $29,000 a day next day. That's a little brain damaging. Let's take some profits. Let's build the bond. Bonds are going to go up in value over the next 24 months. They're not exciting, but you don't have to think about them. And I totally agree with you.
Basically, bonds are ballast in your boat. And to add the visual, it's basically a seesaw. If yields go down, prices go up, and vice versa.
Yeah, that's right. That's right. All right, guys, well, we're going to leave it there. So what a day, what a Fed day. Hopefully the markets can, we'll see if they can continue this rally, obviously for the rest of the, rest of August, rest of the quarters, but we'll see. But Sam, I hope to have you back definitely before the election, because we didn't even talk about politics and what the impact may be on the markets, but then we'll save that topic for another time.
Sam is too smart to talk about politics, okay?
Yes, he is, but he is a historian. He would tell the audience what they might be able to expect as we get closer to November.
A Donald Trump and a Kamala Harris boy, that is historic. I am with you there. That is historic.
That is
As
historic.
Linus once said, I don't talk religion, politics, or the great pumpkin.
That's great. Well, Sam, thanks again for joining us today.
Thank you, brother.
All right,
that
guys.
was fantastic. So on behalf of Sam Stovall and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.